The year was 2008 and the subprime crisis was collapsing the global economy.
The Nasdaq dropped 1.7%, losing over 37 points. Apple shares fell sharply in the morning.
We're down 3 to 4.5% overall in these markets.
Let's talk about how quickly we're seeing this market deteriorate.
We're down more than 16%. Meanwhile, the Dow Jones has fallen about 18%.
All the stock exchanges in the world have dropped by an average of 40%. General Motors, Chrysler, and Ford avoided bankruptcy only due to an $80 billion injection that the American government used to rescue its auto industry from bankruptcy. But at the height of all this crisis, Volkswagen, literally from one day to the next, became the most valuable company in the world. The one responsible for this absurd increase in value, its German compatriot Porsche. I know it sounds crazy, but Porsche is known as an investment fund that sometimes makes money with cars. In one of the biggest manipulations in history, it made much more profit on the stock market than by selling its own cars. How all of this happened is what we're going to find out now. First of all, it's necessary to understand how money is made in the stock market. The basic mechanism that everyone knows to make money with stocks is to buy low and sell high. But the mechanism I really want to explain is the so-called short. Short in the financial market is the possibility to profit from the drop in the price of a stock. It works more or less like this. Imagine that Petrobras's stocks are falling and you believe that this trend will continue. So you see the opportunity to short its stocks. You go to the broker's platform and borrow, let's say, 1,000 shares of Petrobras. But remember, you don't own these shares. You borrowed them and you'll have to return them in the future. In this fictional example, let's suppose the shares are worth 10 reais each. So by selling the 1,000 shares for 10 reais each, you made 10,000 reais. But now you need to fulfill the contract and return the 1,000 shares. After some time, the shares drop to 6 reais each. At that moment, you buy 1,000 shares again to close your position. Don't forget, you have 10,000 reais in your account and you'll pay only 6,000 reais for the same 1,000 shares. So in this short, you profited the difference between the price you sold, in this case 10,000, minus the purchase price, in this case 6,000 reais. In other words, you ended up with a profit of 4,000 reais. In short, you sold high, bought low, and made a profit from the difference. That's how short selling works. Basically, making a profit by betting on a decline. Short can also be called short selling or taking a short position. And the investor who goes short is called a short seller or a short position trader. But it's not all perfect. There is also the risk of losing money with short selling. If the stock rises, the short seller must close their position, buying them back at a higher price, thus taking a loss. You sell for less and buy for more. To simplify our earlier example, 1,000 shares of Petrobras sold for 10 reais each. Contrary to expectations, the shares rose. You had to buy them back for 15 reais each, paying 15,000 reais to exit your position. So in this case, your loss would be 5,000 reais. Volkswagen and Porsche's relationship began in Nazi Germany. Ferdinand Porsche decided to open an automotive consulting company. At Hitler's command, he was responsible for the Volkswagen Beetle Project 1934. Porsche only opened its own car manufacturing subsidiary in 1948. They collaborated for many years, with Porsche outsourcing much of its car manufacturing to Volkswagen. But moving a bit forward in the timeline, we get to 2005. In a secret meeting, members of the Porsche family approved a resolution to buy 80% of Volkswagen's common shares. Something extremely bold. It was like a sardine wanting to eat a whale. To put it in perspective, Volkswagen made 14 times more revenue than Porsche. Its production volume was 60 times higher. In September, Porsche publicly announced its intention to buy 20% of Volkswagen, with no intention of acquiring more than 22%. The manipulation begins here. On June 23, 2006, Porsche announced plans to buy 25.1% of Volkswagen, with no intention of exceeding 30%. In 2007, Porsche's plan to buy Volkswagen was clear after it acquired over 30%. Legally, an acquisition offer was required. But 2008 was not far off, and with it came the crisis. Companies in the automotive industry were among the most affected by the drop in sales and an increase in debt. While General Motors, Chrysler, and Ford were on the verge of bankruptcy, the projection was that Volkswagen would be next. It was the ideal setup for stocks to plummet. But until October 17th, Volkswagen stocks were in an unusual and unfounded upward trend. So this is the point where investors, mainly hedge funds, which are groups of investors with millions or even billions, started to take short positions on Volkswagen's shares. But what was predictable happened. From October 17th to October 24th, Volkswagen shares dropped 42%. Billion-dollar funds on Wall Street, which bet on the drop in shares, were grinning from ear to ear, watching their billions increase by a few hundred million more. On the other side of the coin, the situation was serious for Porsche. Even more so after taking out a 10 billion loan in March to fund Volkswagen's acquisition. But she had an ace up her sleeve that would surprise everyone. On Sunday, October 26, 2008, Porsche dropped an atomic bomb on the market. In an official press release, Porsche shocked all the short sellers. Due to the dramatic distortions in the financial markets, Porsche Holding Societas Europea decided over the weekend to disclose its shareholdings and hedge positions related to the acquisition of Volkswagen. At the end of last week, Porsche Societas Europea owned 42.6% of Volkswagen's common shares, and in addition, 31.5% of the so-called options related to Volkswagen's common shares to protect themselves against price risks, representing a total of 74.1%. Simplifying this announcement from Porsche, in other words, it had officially, as everyone knew publicly, 42.6% of Volkswagen's common shares. But what nobody knew or expected were another 31.5% of shares through call options. A complex financial engineering was created by Porsche so that no one would know that it held Volkswagen call options, which basically means the right to buy a certain amount of shares at a specific price at a future date. To do all this in secret, Porsche made a deal with a bank, and that bank made agreements with several others, so that each one would buy less than 5% of Volkswagen's shares, thus keeping everything secret, because in this way they would stay below the legal limit for disclosure when such a purchase exceeds 5%. In summary, not to get into boring and hard to understand technical terms, Porsche secretly owned a bunch of Volkswagen shares through other banks with call option contracts. All this, after the press announcement, caused Volkswagen's stock value to soar absurdly to the point of making it, for a brief period of time, the most valuable company in the world with a market capitalization of 420 billion. But the main question still hasn't been answered. After all, why did this happen? Why did the shares increase so much in value because of a simple announcement? Porsche's press announcement made it clear that in addition to the 42.6% of Volkswagen's common shares it already owned, it also had another 31.5% of Volkswagen's shares through options. In other words, 74.1% of Volkswagen shares in total were in Porsche's hands. Added to that, another 20.2% belonged to the German state of Lower Saxony. So Porsche and the German state combined held 94.4% of all Volkswagen's common shares. That is, only 5.6% of the shares were available for trading. To make things worse, the Deutsche Aktienindex, the German stock index, also owned roughly 5% of Volkswagen shares. In other words, at the end of the day, Only 1% of the shares were free to be traded. Billionaire hedge funds went crazy because there were several investors with short positions in Volkswagen shares, betting on a further drop in the price. On the previous Friday, Volkswagen's common shares closed at 211 euros. Since Porsche's announcement was made on Sunday and the market was closed, the shares went up sharply on Monday, and already on the following day, the price reached over 1,000 euros per share. This sudden and tremendous appreciation was the result of something called a short squeeze. You remember, right? Short sellers, or shorts, will always have to close their position either by buying at a lower price or by purchasing at a higher price to fulfill their contracts. Short sellers were spooked by Porsche's announcement and quickly closed their positions so they wouldn't lose more. Porsche cornered them. In total, they had borrowed around 12% of Volkswagen's shares to sell them short. They had to buy back 12% of the shares, but there was only 1% available. The demand for buying shares was much greater than the supply of available shares, so that made the prices skyrocket. This Porsche short squeeze on Volkswagen became known as one of the biggest of all time. It became known as the most painful day in billionaire fund managers' careers. There are reports that many were crying on the phone, watching billions of dollars bleed away live. A 2017 case study concluded that Porsche manipulated the German stock market to save itself from insolvency. They also analyzed the European Union's capital market and saw that regulation is limited and favors this kind of manipulation. Porsche, in this whole move, made a profit of 6 billion euros. The short sellers ultimately lost 20 billion in total. As a result, Porsche gained a reputation as a hedge fund that occasionally earns money selling cars. It was the automaker that made more money in the market than in its main business. Just to give you an idea, in the fiscal year of 2007, Porsche made 3 times more money in the financial market than from selling cars, and the following year it was even more. They made 8 times more profit with Volkswagen stock options than from selling their cars. There were lawsuits and investigations, but Porsche was never convicted. Porsche kept buying Volkswagen shares, but things kept getting worse. The stock price started to decline. At the same time, Porsche's sales also dropped. From 2008 to 2010, more than 50% of the market value of both companies was lost. Porsche, even though it made a lot of profit in the stock market, almost defaulted because of its high debts. And it also failed in its attempt to buy Volkswagen. Even with help from Qatar, investing 7 billion and taking on debts in exchange for a stake in both companies. Partly because the German government has what's called a golden share 20.2% in Volkswagen, which gives the government veto power to prevent what they call a hostile takeover or privatization. But the saga between the two German automakers ended with them merging, but that's not the main point. The main point of this video is that unregulated markets lead to manipulation. If the famous whales of the financial market with billions of dollars in investment funds are manipulated, imagine us, mere investors, individuals, what could happen. That's why some people say the stock market is just a casino.